Now, if you remember this morning, we had a very, very interesting political debate on the future of Europe. And over lunch, we also heard the point of view from the European central banks in terms of risks for growth and opportunities, of course, for growth in the Eurozone. Now we would like to focus on views from across the industry. And as we're just laying here the final touches, but it's a big panel, so it'll take me a while to get through all the names. First of all, we're very delighted to have a good friend of the IIF here with us to moderate this panel. His name is Reza Moghadam. He's the Vice Chairman for Sovereigns and the Official Institutions at Morgan Stanley. So he will steer the conversation alongside a really interesting panel. Jordi Gual, he's the Chief Strategy Officer and Chief Economist at CaixaBank. Alejandra Kindelán, she's Senior Vice President and Head of Research and Public Policy at Santander. Erik Nielsen, Group Chief Economist and Global Head of CIB Research at Unicredit. And Hugh Pill, Managing Director and Chief European Economist, Goldman Sachs. And the timing just now was perfect. Please, ladies and gentlemen, give this panel a very warm welcome.
It's a pleasure to chair this panel. We have people with great expertise on European issues. We have already had a lot of discussion of European economics and politics. So the idea is in this panel, we will delve into more detail on some of the economic issues. We are planning to cover 5 issues, 2 of them briefly, and perhaps the other 3 in more depth. First of all, you're all aware that there has been an agreement in the Eurogroup on Greece. So I wanted to get the impressions of the panel on that, what it means for Greece, what it means for Europe moving forward. There has been a very rich discussion of Brexit, perhaps from a political point of view. We will focus a little bit on the economics of Brexit, both economics of what it means for the UK itself and what are the implications both of an exit for the Eurozone and the EU as a whole, and also perhaps the aftermath if the Remain campaign succeeds. Third topic, financial sector, banking in particular. We are all coming from the banking sector. And there's been a lot of focus recently on the banks. The market is, to say the least, volatile. It is a global phenomenon, but there's been a particular focus on the European banks, and their share and CDS spreads have been under pressure. There's been talk of resolving the bad assets. There are some interesting initiatives in the pipeline. There is talk of the need to do more on the policy side. We will cover these issues as well as the important issue that was touched on earlier in the day about risk weight of the sovereign assets. Fourth topic, we had an interesting lunch on monetary policy in the Eurozone. And we had 2 very interesting presentations by 2 central bank governors today from the Eurozone. And I would like to get the perspective of the panel on negative interest rates, future of quantitative easing, as well as a topic which has come out throughout the last 2 days, this fear of competitive devaluation. And finally, if time allows, we did have 2 presentations by the French Central Bank Governor and the Dutch Central Bank Governor about the architecture of Eurozone and how it should move forward. And so if time permits, we will also touch on those issues. But let me start very briefly on Greece. What did we make of what was achieved last night? How significant is it? And what does it mean moving forward for the Eurozone in particular? Jordi.
Yes, thank you, Reza. Good afternoon. I think that we should all welcome the agreement that was reached yesterday on the Greek issue, yet again. I think that it shows that there is the will to compromise and to get to agreement. Of course, the agreement is still not full regarding the IMF, and the IMF will study the debt sustainability conditions in more detail. But the agreement is good because it strikes a balance between the two parties, the need to make the debt more sustainable from the point of view of the Greek economy and to be able so that the economy can grow out of debt over time, and the request by some creditors that the face value of the debt is not changed, so that we keep on with the rules. On the other hand, I have to say that we should all be taking into account that what is happening and what has happened to Greece over the years has shown that within the Eurozone, we don't have neither crisis mechanism devices that allow us to fight against this happening again, nor a sufficient governance structure and a way to deal with the incompleteness of the banking of the European Union, of monetary union. And this brings me to the fifth issue that you have mentioned that was discussed today by two central bank governors. And I certainly believe that we should keep some time for that, because discussing those reforms is a must for Europeans, and in particular for Eurozone citizens and institutions.
Thank you. Alejandra.
Thank you. I think I totally agree. I think this is definitely good news for Greece, good news for Europe too. There is, as Jordi says, a lot to do still, of course. We hope this can also lead gradually to a certain normalization of the financial sector in Greece, possibly regaining access to the ECB again, removing capital controls, all these distortions that we've had in the past in Greece. It also demonstrates that Greece is committed to reforms and able to take them, to adopt some of these reforms. Of course, the situation is still weak and vulnerable. The economy needs to show growth. The fiscal situation, of course, is also difficult. It has ambitious objectives it needs to stick to for the next years. So it will continue to be a potential source of concern, but I think that we are taking the steps in the right direction and giving it some breathing space for the next few years.
I must say, I have the famous iPad in front of me, so if you have questions, do send them in, and I will field the questions. Erik.
Right. Thanks a lot. I'm sort of taking a little bit different view of this. It bores me. I'm not really interested in Greece anymore. It's a mistake to extrapolate anything about Greece onto the Eurozone. It's a country that is not functioning well. The institutions are not functioning. They lied about the data. We had a crisis. We sort of I hate the term, we're kicking the can down the road. And that's what happened again. I mean, for us who have worked at the IMF and visit Berlin occasionally, it's been a very amusing show to see the game between the actors here. But yeah, we bought time to after the German and French elections, and Greece is staying in the Eurozone. But if you're a speculator, it was interesting, you could make a bet on this. If you are a real money investor or FDI guy, it's irrelevant.
Thanks. Hugh.
Well, first of all, thank you for the invitation to be here. I mean, I would echo comments that you heard. It seems to me that what we've seen... all of them. All of them. Wait. So I'm not sure you're disagreeing so much. I think the reality is what we've seen is trying to navigate a way between an economic reality and a political reality. I think you could say the difficulties in doing that demonstrates how Europe works, when it really demonstrates how Europe doesn't work. And I agree with the points that we need to make it work better. But I think fundamentally, if we'd been having exactly the same discussion a year ago, I don't think Erik would have been so bored. And I think the fact he's bored now is really a sign of progress, because I agree with him. In the end, from a broader area-wide point of view, broader global financial point of view, we are slowly, and unfortunately too slowly, neutering the problem. It will take a long time to neuter this problem further and really cure it, but I think it's a step in the right direction.
Thanks to all of you. the Financial Times has a report on it, and it quotes a European official which says, if it looks like we have kicked the can down the road, we have. So perhaps that's the best summary coming from someone who was in the negotiations, admitting exactly what they have done. So I think this was a brief discussion, a sort of indication also that perhaps this is not issue of concern, but it is an issue of interest, some progress there, but a lot of unanswered questions, particularly about Greece and how the debt deal would move forward. But I think also what Jordi said, and Hugh emphasized, very important, it also points to a fundamental need to think about the Eurozone architecture and how to handle these problems. Again, hopefully we will come back at the end of discussions to that. Let me turn to Brexit now. It is interesting, for instance, listening to some of the speakers today, like on the European politics panel. It is also interesting looking at what people write about it. There's been a lot said about the politics and implications. There's also quite a lot said about the economic implications. But I think they're still interesting to look at. A lot said more about the implications for the UK rather than more about the UK, less about the implications for Europe of either scenarios, exit or remain. I know Hugh has done a lot of thinking and talking about this issue, and so I would like to turn to him first.
Well, yeah, I think it's striking to the point you made that certainly someone living in London, British, you hear a lot of heated political debate, but that contrasts very dramatically with really a very broad consensus among economists about the downside that exists from an exit from the EU on the part of Britain. There are exceptions to that, but if you look across the international organizations, the official institutions in the UK, and most of the financial organizations, including many of those represented along the row here, I think you come up with a very broad-based view that there is a cost to leaving. If you compare performance of the UK economy in a reformed EU versus a current EU versus a sort of Swiss or Norwegian style arrangement versus a completely WTO-based arrangement, you would order the ranking of those from an economic perspective in that way. There's a lot of debate about how big the gaps are. I'm not sure that the numbers we've heard are entirely reliable. What I would emphasize, though, and maybe this again blurs the distinction between the economics and the politics, is while I would personally subscribe to that ranking, each of those points does rely on sensible policy decisions being made both in the UK and in Europe. And one of the reasons why I would have some skepticism about the exit scenario is that I think that will create an environment where we may not see good policy decisions. And that probably broadens the gaps amongst these various outturns in the longer run. Where I think, again, there's probably also a high degree of confidence, and this is where we've done quite a lot of work ourselves, is that the uncertainties engendered by an exit would weigh quite heavily on UK activity. That, in some sense, can be partially a temporary shock, but nonetheless, in an environment where there are other weaknesses in the global and European economies, it's unhelpful. And certainly, I think part, at least, of the slowdown we've seen in the UK economy in the early part of this year is reflecting these uncertainties. On the European side, I will leave it to others to go into more depth, but I think it's equally hard to envisage that UK exit is a positive for the rest of Europe. The uncertainties break down in relationships, business flows, and so forth, financial flows, would, I think, be costly to Europe directly, continental Europe directly. But more importantly, and again, maybe touching on the boundary between the political and the economic, there is this danger that Brexit would act as a catalyst for an unwinding of fragile institutions, partly related to what we just discussed over Greece, fragile institutions in the European Union as a whole, including in the euro area. And any unwinding in that direction from an already very fragile environment, I think, could be very costly.
Thanks, Hugh. Maybe I come that way. Erik?
Right. So I won't repeat what you said because I share it completely. We have run our models and considerations about the growth forecast if Brexit happens. We don't think it will happen, but reading the opinion polls, but if it were to happen. But before I tell you the numbers, I'll emphasize how unsure we are about this, because it's all about uncertainty. I mean, there's all the forecasts 5 years out, 10 years out, and we broadly subscribe to those numbers that you know them from the Treasury and all the other ones. But we will have a minimum of 2 years of huge uncertainty. And not only 2 years, because I strongly doubt that we have clarity within that 2-year period that the window gives you. I don't know of any major trade agreement that's been agreed and ratified within 2 years, even within 4 years. There's about, I think, 15,000 EU resolutions applied directly in Britain. This is internal market stuff. The only way you can realistically deal with this in Britain is to take one envelope and make it all into British law. You cannot go through 15,000 of this. Now, that means that when the 2 years are done, presumably a Brexit government will start to unravel them afterwards and make some different things. So uncertainty will be very long and very substantial. Round number, right now with our main case scenario that it's a Remain vote, where we have a bit over 2% growth forecast next year in Britain, we will lower that to about 0. And spilling that through and applying these uncertainties, that takes almost 1 percentage point off our growth forecast for the Eurozone, round number sort of thing. So I think this is a very substantial issue for everybody. But let me say one more thing, just trigger what you said about the risk of unraveling. I don't really subscribe to that. I fully accept all the uncertainties, the Austrian vote and all the rest of it. But first of all, it's a very different story about leaving the Eurozone than leaving the EU. If you think EU leaving is difficult, Eurozone really, really, really whole different ball game. But also, of course, there could be some pressure on the Poland's of the world, but it would be temporary in a sense. And I think actually if there were, the first reaction I think would happen the morning after a Brexit vote is there would be a communication between Berlin and Paris to an extent we have never seen before. Because the Germans have one big fear in life, really only one big, and that's Europe breaks apart. There's history, it's commercial, it's geography, it's everything. And while they may have, they're much more Anglophile than most people realize, I think, but there's only one thing that really matters for them, and that's to stay close to Paris. So you could actually imagine a scenario where core Europe would move closer because of this. That, of course, means the Eurozone primarily. But I'll just leave it like this because maybe we'll come back to it.
Alejandra.
Thank you. Well, I think there's not much to add to the general outlook and what this would mean in economic or quantitative terms. Of course, we've already seen the impact of uncertainty in the UK economy, and this would certainly go on. The Bank of England even said that even if Britain stays in, there would be these impacts would be felt or be visible for still some time. But I think I would like to add to the discussion the impact that the UK exiting would have for EU relevance in the world at a time where we face very big problems, all of us, not just Europe, and we need to face them and try to find solutions to these common problems together. So otherwise, solutions will be found for us as Europeans, and I think we need to really take this very seriously. So that really, that this is our main concern.
Jordi.
Most has already been said, but let me emphasize that the Brexit is a profoundly asymmetric shock. There are losses to diminished integration between the UK and the rest of the European Union economy. But it is an asymmetric shock. The losses are mostly on the UK and to a degree in the rest of the European Union. And in particular, the UK is underestimating the losses for the city. Maybe not the city itself, they are not underestimating that, but the UK voter in general. Having said that, of course, it's not good for the Union, and we are in favor, of course, of the UK being a part of the European Union. I have to say that if the UK were to exit, negotiations between the Union and the UK, I'm sure they would be rather tough and protracted. If anything, because you want to get the right signal to other members of the European Union. So leaving the Eurozone is unthinkable. Leaving the European Union must be almost unthinkable. I believe. So negotiations would be tough, whether in the WTO regime or in the Norwegian regime or whatever. And last but not least, and linked to that, I sympathize with what has been said. Is this a positive for the European Union and for the Eurozone? No, but if it were to happen, since within the Eurozone we urgently need a leap forward, maybe the coalition of the willing that was mentioned this morning or this morning in one of the sessions would take place, and the connection between France and Germany would strengthen and push the engine of European integration ahead. So it's not that I'm betting for that. It's not that I wish British Brexit, but we certainly need something that helps completing the European Monetary Union. It should be something else, not Brexit.
Thanks. Two questions. I'm looking at the questions that are coming in. Maybe Hugh on the first question, and perhaps Erik or Jordi on the second question, because they were relevant to the points you raised. First question, isn't there a paradox that the implied sterling depreciation would be positive for the UK in an exit scenario, and really negative for the EU due to nationalization spillovers, quotation marks here. So maybe that question. One point I want to pick on what Jordi and Erik have said, this idea that the rest of Europe, particularly in the Eurozone, will come together if there was Brexit. I want to look at the opposite of that. Suppose there is Remain. UK remains, but the fact that this referendum has taken place, and the fact that you see all these centrifugal forces in Europe, actually makes it quite difficult to have any kind of integration, good or bad. That, for example, there's been a lot of talk about banking union. Completing banking union in an environment of political pushback on closer integration will actually become more difficult in either any scenario, particularly in the Remain scenario, which is sort of seems to be the base case. Maybe I turn to Hugh first, and anyone who wants to just indicate to me if you want to come in on the second question.
Well, I mean, very briefly on the issue of sterling. I mean, I would say, yes, other things equal, weaker sterling should support growth and boost inflation, and these are things the UK would benefit from. But I think it's important to emphasize that weaker sterling is a consequence, in the type of scenario I think we're talking about, of something bad happening to the economy, and a response to that probably including a policy response from the Bank of England. And the bad things that are happening to the economy will be somewhat offset by a weaker sterling, but the bad things will still predominate, given, for example, the numbers that Erik talked about. So I think you need to sort of separate cause and effect here. So I would be skeptical of that type of argument. I would also think, frankly, that the euro is somewhat vulnerable post-Brexit too. So it's not self-evident to me that you would necessarily see a big move against the euro. You might see sterling move more against other currencies. And then very briefly, to pick up comments you made, I'll be interested what others say, is that I would agree that the unraveling I have in mind is less the unraveling of countries splitting off the EU. I think the unraveling I have in mind, perhaps better put as kind of an institutional or governance unraveling, which is a version, I think, of what Reza was saying. Namely, this is the last thing Europe needs, in my view, is a big distraction. And all that difficulty of negotiating a trade agreement with the UK will be very costly for the UK officials, but it will be also very costly for the European officials, who are very clever people, very hard-working people, but nonetheless would be better employed doing something else for the reasons we discussed earlier.
Anybody wants to come in on any of the questions?
The second point, well, I think that we have to draw a clear distinction between the Eurozone and the European Union. If the UK remains, I think that this has implications, but we have to realize that the whole Brexit debate has to do a lot with the freedom of movement. Less so with the issues of financial relations and the role of the city vis-à-vis the Eurozone. So I think that that should then change significantly the Eurozone agenda that we were discussing before, the things that we still need there in terms of banking union and in terms of some degree of fiscal backstops that may be needed, and all this debate about the small steps and the large design of the 5 reports presidents. Because the British main political concern is the freedom of movement. And they have already reached a tentative agreement, which is part of the agenda that Mr. Cameron has presented in order to increase the chances of a Remain vote.
Thank you. Maybe given the fairly consensus views on the panel, we should move to the next question. Somebody said to me recently, if you want to make market people frightened, mention 2 words, European banks. So let's turn to European banks. We have quite a few European bankers on our panel. And the issue of resolution of bad assets, the market perception of the fact that European banks trade as low as 30% of book value, and discussions about their asset side, particularly the sovereign bonds and what you should do about them before any kind of risk sharing comes up. So I think, given Erik, that your bank has particularly been in focus here, and you were involved in the interesting initiative of Atlanta in Italy, perhaps you could start giving us your thoughts on this.
Happy to. Let me start by saying, if you can buy something at 30% of book, you really have to be a pessimist not to do it, right? I mean, my goodness grief, I mean, that looks like a bargain to me, but let me maybe stay away from the recommendation like this and talk about the issue of the banking. Let me make 2 or 3 comments on this. The first thing is, when there's a banking crisis, we know how important it is to act fast and decisively from the government sector, but also for the banks, for that matter. And that's what you saw in America, and you saw it in Spain, you saw it in some other countries. But the important thing is here, well, in Italy, nothing was done for a long time, and I come back to that for a second. But just to remind you, on IMF numbers, Germany spent about 12% of GDP in total between 2008 and 2014 bailing out banks. The Netherlands, 17%, Britain, a little over 10% or thereabout, France and Italy, less than 0.5% of GDP, right? So that's just sort of to remind you that this was, and to some extent, this is one of the reasons why Italy has all these NPLs, because it was never cleaned up along the way. Not the only reason, but one reason of it. Number 2, but the train has left the station. So I'll give you an example. At least it feels when you work for a bank in the peripheral that the train has left the station with regard to such government support. Although, it was curious, it's only 2 weeks ago that HSH Nordbank in northern Germany got permission from Hamburg and Schleswig-Holstein got permission from the European Commission to add another 3 billion euros in guarantees for them to clean up a NPL situation of about 9 billion euros. That takes, incidentally, to give you the order of magnitude, because I'll come back to that takes the total government support by Hamburg and Schleswig-Holstein for Nordbank to 10 billion euros, which is about 5% of GDP of Hamburg and Schleswig-Holstein. Not legally underwritten by the German Federation, but if anybody thinks the German Federation would ever let those 2 states go bankrupt, we'll have a conversation outside afterwards. Now, coming to the Italian NPLs, which you see these 300 billion running all over the place. Just to give you a sense of the real magnitude, these are obviously right numbers. There are sort of 2 categories, they're very bad and they're not so bad. If you take the coverage ratio, and I won't go through all the numbers here, but you take the coverage ratio for each of them, and you apply, assuming a price of 20 cents on the euro for the really bad and 40 cents on the not so bad, which is quite conservative, I would argue, but around those numbers. Then the hole in the Italian banking system in that is 5% of GDP. So there you get, and that's why I was mentioning the 5% for Nordbank alone, right? So it's to give you an order of magnitude and compared to the overall bailout in many other countries, these numbers are not actually huge, and they are resolvable in a normal environment. And if Italy had gone fast and early, but they didn't, and the train has left the station. So when the Italian government sat with the Commission to get the deal for how the banks could unload these NPLs, the whole hassle was what you pay for the guarantees. They had to be market priced, and no subsidy allowed. And then you have what you have, which is a structure that is probably almost useless. So there you have it, and then you have Vicenta and the rest of it, and we can talk about the details of this. And then we get Atlante, and then in our case, all hell breaks loose, because they are basically seeing that for places like Unicredit, but also other Italian banks, but particularly us being the biggest bank on assets, is that, according to market participant I've talked to, is that now suddenly we have a contingent liability, which is all these small Italian banks. Because the Italian government are not going to spend money on it, the Commission are not going to allow them to do anything, and then you go to the financial sector. It's not only us, there's 62 investors in Atlante, some all the way down to €1 million. So to say that it was just sort of put together to rescue us or somebody else is probably a simplification, but it is seen as a rightly or wrongly, as this underwriting, and then you have a problem, right? So I think this is just to put the things in perspective, how do we get out of it? I think the train has left the station. There is no other way than just work yourself out of it and persuade the market that they are on a trend downwards over some time. And importantly, the government's decree that will be passed into law here in early June, almost for 100% sure, that will significantly ease up the way through the judiciary system of cleaning up, these assets, will help a lot. So I'm actually relatively optimistic on this, given the circumstances. Let me finally say something about the risk-weighted assets, which I think is a complete, utter disaster, and I am utterly stunned that serious economists or policymakers would even bring this to the table. Think about this for a moment. You're asking governments to go out and institutionalize that I'm not risk-free. The government. I pay pensions. Poland was an example here. It's like who moved from a fully funded to a pay-as-you-go system. Nobody really cared. Governments pay pensions, they pay wages, they pay procurement, everything else. And this is all political commitment, nothing more. And then you issue debt that's a legal financial commitment. And you are saying, let's build something in order so you can easily get out of those type of things. This is like emerging market stuff. I think it's incredibly dangerous. And I think it is, and it's pro-cyclical. It has a lot of technical problems, but the very philosophy of it I find stunning. That doesn't mean there shouldn't be limits, but don't make them a risk weighting and depending on some mad credit rating agency's evaluation that will make it pro-cyclical. As I said, make some limits, for example, to capital.
Erik, as you were talking, lots of questions were coming in about Italy, the banks, Atlanta. I think you gave a comprehensive answer, very clear. But I like to pick on one issue you said and have other people's views. You seem to suggest that because there is no kind of backstop government guarantee, and given where the valuation of assets are and where the provisioning is, it's going to be quite difficult to resolve these assets. It would take a long time. At least it would require growth, but growth on the horizon is not very strong. So it seems from what you say, you're resigned to a situation where the NPLs remain high for a long time, and probably a banking system which is clogged up somewhat. And as we heard throughout the last 2 days, policymakers kept emphasizing the dependence of European lending on bank lending because capital markets are small. So this does not seem like quite an optimistic picture here. I wanted to turn to others to either give their views or tell us what to do about this. Maybe, again, I move this way, Alejandra.
Thank you. Well, we've had a very positive experience here in Spain, I would say, in restructuring the financial sector. It's true that we did it, before the train left the station, as you said. No, things were different. In 2012, 11 and 12, we were in a deep crisis here. But lots of measures were taken, and maybe just I was writing down the many of the things that we did to see if they're helpful. But we did a very the first thing we did was a stress test that was led by Oliver Wyman. Then we did a transparency exercise of our collaterals. We call it the real estate striptease. I don't know if it's a very nice name, but that's what it's called. We did very strong provisioning that they follow the name of our Minister of Finance, Minister de Guindos, so we call them the Guindazos, 80 billion in provisions in the banking sector in total. We changed our insolvency laws. That was important too. It has been very important to support off-court procedures and to avoid blockages in the restructuring agreements. We created a bad bank, 55% private contributions and 45% public contributions. That would not be possible today, I suppose. And what all this has resulted in also is that we are, there's a lot of sales of NPL portfolios. So our bad bank has been, Sareb, has been selling NPL portfolios very intensively in the past years. In fact, last year, 16% of the reduction of NPLs in Spain was due to these sales of portfolios. So all in all, I think that this restructuring has been very positive. The banking sector in Spain today is in a capacity to provide credit. In fact, credit has been growing significantly. New credit has been growing significantly in the past few quarters. And the situation is radically different to what we had a couple of years ago. It's true also that the sector has consolidated a lot, and we are fewer entities now competing toughly for credit.
Jordi. Yes, I want to complement that, because I think that the fact that valuations went down dramatically in the industry should not be attributed to the NPL problem. After the comprehensive assessment that we had a couple of years ago, valuations have gone down again. There might be some problems in some specific countries, and as we were told about Italy, maybe Portugal or Greece. But there are other problems that are impinging upon the industry that keep valuations low. And in particular, I would like to highlight regulatory uncertainty, the lack of clarity. We have a cumulative amount of regulations which are being put into place. We don't get full clarity as to the amount of equity that will be asked for the industry, what will be demanded. There are lots of questions about some of the debt instruments which are going to be eligible for the bail-in process. The whole bail-in process design, it's under question mark. And at the end of the day, the industry is facing an unbearable situation, because the whole exercise of Basel III was trying to diminish the leverage of the industry so that the industry became safer, less profitable, but also less risky, so that both the return on equity goes down and the cost of equity goes down, but the industry is viable. Maybe a bit smaller, but viable. Now, we are in the worst of the scenarios, because the return on equity has gone down for cyclical reasons, but maybe also for structural reasons, and the cost of equity is stuck at about 9%, and some of us believe that this is most likely due to the fact that we have this either regulatory uncertainty or the fact that investors believe that this regulation increases the risks of the industry. Of course, it could well be that investors believe that the risk of the industry is associated to a scenario of very low interest rates for many years, the flat yield curve, or maybe the challenge of entrance in the technology domain. But I believe that a lot has to do with this process of regulatory mess in which we are. And of course, authorities keep telling us that this is the last year. Let's hope it is, because we've heard this message the year before and the year before the year before.
Thanks a lot, Jordi. Just very briefly turn to Hugh. As a non-European banker, and an ex-ECB official with a question. We have heard, is it really the regulatory environment, or is it that the European banks just don't have enough capital and they are not able to write down sufficiently?
Well, I think it's a combination of various factors. That's an easy answer, typical economist answer, but I think it is. I mean, what I would say, which perhaps leans slightly in the capital direction, is just to address a couple of points Erik made. First thing is, from a macroeconomist point of view, what is striking is, despite all the difficulties and complications and market tensions, most of the, say, ECB data suggests that credit conditions in Italy from the banking system have been easing. If you look at the bank lending survey, if you look at bank lending rates into the real economy to small businesses and so forth. Now, this may not last, but it does suggest that perhaps the issues are more segmented, or at least in the past have been more segmented, and there are dangers, which you pointed to, of desegmenting them. Second thing I'd say, which goes a bit back to the governance issues and perhaps touches on the capitalization issue, and it's implicit in what's been said. I mean, there are reasons why Italy didn't move fast, which is basically it didn't have the fiscal capacity to move fast. And that's a problem. And related to that, I think, in order to persuade people to move fast, Europe has a tendency to introduce rules, so the regulatory aspect, where they say, you've got to do something before this rule comes in, because you won't be able to do it once the rule is there. And the trouble is, if you can't do it before the rule comes in, you've got a rule which may be stabilizing in some new steady state world where all balance sheets have been cleaned up and things have been moved forward, but maybe actually be very destabilizing in an environment where, because of other constraints, you haven't done that. I think the situation of public money into Italian banks may be one example of that, and I think the point made on the risk weights on holdings of sovereign debt, although maybe I wouldn't go quite as far as Erik did, I would say that there's a danger that you go down the same route there.
I know there is a two-hander from Erik, so I will come to you. But one question also, you brought up the issue of risk weights. That's one thing. There is also the large exposure of banks to their sovereigns. That in a way there has been, if you like, progress through BRRD in making the sovereigns safe from the banks, but the banks are not safe from the sovereigns the way it's currently structured. And so surely there is some logic to reducing the large exposure of European banks to their own sovereigns, and your chance to respond to this issue on capital.
No, so I hope I said clearly I'm not opposed to limits, and I think you put it well. I should have said large exposure limits. Maybe it's 100% of equity or whatever. It's another thing. It's I don't know what the number would be, but I think I completely agree that is a reasonable way of thinking about it. And I also, I think Peter Brett said it really well. I mean, the way to really disconnect banks from the sovereigns is to have European banks, really have a true banking union, maybe a European banking license, because until you get that, as he said, I mean, if you tomorrow took all the BTPs off Unicredit balance sheet and you defaulted the sovereign in Italy, I can guarantee you we will be in big trouble, right? Because it is exposure also to the private sector. So I think this is a really, really important point. So I completely share your view. I didn't mean to say that there shouldn't be any limit. But I wanted to also reply to you. You're absolutely right. I mean, the numbers from the ECB are clear that the lendings are going as fast as you actually want it. In a sense, there is no real sign, and I can tell you from our own experience, that there is not really, our lending books are expanding as we want them, more or less. I mean, this is not the problem we have, and the NPLs don't restrict, at this stage at least, the lending and our ability to meet the demand for loans. If I can say one issue we have is indeed that we get too many deposits. This is the issue, right? We are like some other bigger banks in a place like Italy. We get deposit inflows like there's no tomorrow from smaller banks where people maybe get a little bit nervous. But what can we do with the money? Because of the liquidity ratios and other new regulations that came into force, we are very restricted from doing simple maturity transformation. This deposit come inside 30 days, so we're stuffing it, have no choice, at the ECB at -40, and then we have to go out and borrow just before the TLTRO2. You may have seen, we did, I think it was a 7-year, we paid 221 mid-swap. It's crazy, right? So in a sense, TLTRO helped in that sense. But this is the problem, that we can't do what an old-fashioned commercial bank like Unicredit usually would do, which is simple maturity transformation. That is probably a bigger problem than none of the others.
Thank you. That was a good entry into our next topic. And given that we are running out of time, and some of you expressed interest to talk about not just the monetary policy, but also the framework for European architecture and decision making, I'm going to combine the two. So you can give your views on both. QE is supposed to run out in March. So what should be done? I have a lot of questions coming through on impact of negative rates. So there is a lot of interest on negative rates. And what was interesting was that we had two central bankers talking about architecture for the Eurozone in particular. So, and these are people who are making the monetary policy decisions. They are asking for a strengthened framework. So perhaps that's a logic to combine the two. So maybe I start with Alejandra and then allow everybody else to come in. But since we are short of time, we have to be concise. Thank you.
3 minutes. Okay.
We're going to run over.
Not even, no, half a minute. Yeah, exactly. Okay, ECB policies. I think they have been effective in reigniting credit in a way and eliminating fragmentation. And there's data that supports both things. But of course, inflation is still the big concern and the objective. So it is possible that the ECB will need to take additional measures. Negative interest rates have a huge impact. I think there's been lots of talk about that already. We already have evidence that the positive impact on growth and on capital gains is being overcompensated by the negative impact on margins overall in the European sector. So we would expect that interest rates will not be the way to act, but possibly extending the horizon, as you mentioned, the QE horizon, or even broadening the range of assets, possibly removing the capital key. We'll have to see. There's difficult decisions to take if they want to move further. But of course, the key to all of this is avoid or prevent or stop over-reliance on monetary policy. We do need fiscal policy, more proactive fiscal policies, and also structural policies to come in. Otherwise, I think the problems will be worse. I don't want to take more time. Sorry.
Thank you. Jordi.
Yes, on the monetary policy, I want to express clearly my view that I've been thinking already for a few, maybe years, that quantitative easing is essentially a beggar-thy-neighbor policy. And that what's happening over the world is that some of the largest economies went into these policies and the others were obliged to follow. And of course, small countries in the neighborhood of these monetary areas, like Sweden, like Switzerland, or the Danish, had to do the same, and the Swiss decided not to, and they went through a huge appreciation. So it's certainly a policy that has reached its limits a long time ago, and also it's quite inefficient because it creates unproductive debt in other places and asset bubbles. As for negative rates, again, it's a policy of last recourse once we see that quantitative easing has already diminished returns. Again, it's a counterproductive policy. I think it leads to financial instability because you get hoarding by citizens. The deposit base may contract. There's nothing more unstable than that. It leads to diminished bank profitability with the risk of unstable behavior by some players. It did not lead to an increase in lending because actually lending rates, like in Switzerland, may go up to compensate for the diminishing rates in the deposit side of the balance sheet. So again, it's a policy that, in my opinion, should be abandoned. And for that, we have to rely a bit on the Fed, because the Fed should be the first country in the world to start normalizing monetary policy. They already started last December, and I think that the conditions in the US are already there to continue on that path. Certainly, the European zone has to continue still with lax monetary policies, but at some point also we should reverse course.
Let me turn to an ex-ECB official. Has QE run its course?
Well, I'm sitting here with a thing saying time's up.
Time's up.
Me. So
I think maybe 1 minute for you and 1 minute for Erik, or Erik can respond afterwards during coffee.
I will be very brief. These are very big questions, but I would say, I mean, I expect, Goldman Sachs expect, I guess, the ECB purchases to continue to be on march. I'm not a great enthusiast then for some of the reasons that have been said, but I actually think that the main impact of the sovereign purchases in Europe has been in creating some of the fiscal space on government balance sheets that was lacking in the past. And I think this gets a little bit to the architecture question, is that across the world, but particularly in Europe, in a difficult institutional environment, we do have some questions there, which are not entirely reassuring from a long-term point of view, but should support the economy in the short-term point of view. I think, just to pick up on things that have been said, I mean, negative rates and QE, through its effect on flattening the yield curve, do have a negative effect on banks. When I talk to my junior economist colleagues, I always tell them there are only 3 things economists know that other people don't know. 2 of them I won't tell you. One of them is general equilibrium. And so the idea that something that seems negative from the individual bank point of view can end up being collectively positive if it does breed more macroeconomic activity, recovery, and nominal growth. That's the line I'm sure you heard from Mr. Pratt at lunchtime, and I think that's basically right. So if you're going to rely on the conventional channels of transmission of these unconventional monetary policies, they mean you will put pressure on banks and asset managers to do things they otherwise wouldn't do. And I think that should stimulate more risk-taking and more activity, but it comes with some financial stability risks, and a well-designed central bank should manage that carefully.
I think given that time is
Can
up.
I just say very, very quickly? So I agree with everything you said. So the only thing is that so much of the money in Europe is managed at heavily regulated institutions, and therefore the risk-taking, including by the banks, cannot take place. So therefore, that sort of makes it complicated. And I hate negative rates, by the way, but that would be over coffee.
Over coffee.
Otherwise,
I think on that controversial note, I wanted to finish on what you said.
Sorry.
But on that controversial note,
Sorry.
Thank you, everyone, for this. We had a good discussion.
Thank you.